The first section that we'll visit is that of using market cap as your guide, because currently market cap is important in understanding where you should be looking at in the market. The second section subsequently will be about sectors and then followed by market breadth. So in the first section, I'll take you through some ratio charts. The heading is here. So the first ratio chart that you see is that of micro caps. This is against performance of sectors and stocks that are currently moving in the market. Now, post September 2024, micro caps have been laggards in the market. And I don't think this particular trend is going to change. Many a times in my previous updates, I've spoken about this, that the SMID space in the market is a bit weak unless you are in those sectors where SMIDs are working. So we may be in another this kind of a phase for microcap where you'll have to wait at least for a clear structure of higher high, higher low in terms of ratio charts in order to begin looking again into this segment. The next ratio chart is of small cap. Now this is small cap 50 and small cap 150 also. See, your aim as an investor or as a long-term trader is to participate whenever you see ratio rising in the market. Again, this is small cap against the broader market, the stocks and sectors that are doing well. Because when the ratio is rising, it tells you that small cap overall is outperforming the market. And that is where you get to make more alpha in terms of money. But when you have such structures where there is a lot of erratic movement with respect to the ratio of small caps against the broader market, you will always find it very difficult to identify those stocks that are going to do well. You'll really have to be good at bottom-up stock picking to identify which small caps are going up. The next ratio chart is mid-cap 50, and this is where things start to get interesting. Mid-cap 50 is actually at an all-time high with respect to ratio chart. This means that mid-cap 50, or for that example, mid-cap 150, there is still significant amount of buying that is happening in this pocket. The next ratio chart is mid to large cap stocks. Now, mid to large cap would mainly be top 200 stocks in the market with respect to market cap. Top 250, you can take it that way. This mid to large cap index exists. That is large mid cap 250 index. If you go to Nifty, NSEindia.com, you'll find this index. Again, look at the ratio. The ratio is at all-time high. This tells you that this is the sweet spot in the market. Mid to large cap is the space where there is a lot of buying happening in the market. And whatever distribution you were seeing since November 1st week, majority of money is flowing into this pocket. Because from ratio chart, it is clear that small cap will take some time to recover. Micro caps will also take some time to recover. I don't have the SME index, else I would have shown you how SME index has actually underperformed the micro cap also by a huge margin. So this particular pocket, I'll just read a couple of things. That is the small micro SME. Now this space is still seeing a lot of distribution, a lot of money outflow. Rallies eventually will happen in between. Whenever you see the broader market rallying, of course, this space will also rally. And that is when people again start buying without realizing that the ratio charts are not in proper structure. But unless the long-term ratio charts improve, avoid this segment. Now, one caveat. If you find small microcap SME from strong pockets of the market, let's say metals, let's say banks, let's say auto ancillaries, autos, or the rare earth space, then yes, you can go behind those stocks because they are backed by a larger sector trend. But mid to large cap is the sweet spot in the market for the time being. You can look only at SMID names if you understand strong sectors. Now, large cap continues to see a lot of inflow. The only drawback with large caps is that if somebody wants to be in large cap, it is much better if you be in ETFs because the transaction costs will be lower. At the most, a large cap in 18 odd months is going to move about 25 to 35%. A proper sector allocation in terms of ETF can give you that much return at a much lower transaction cost. So for real alpha in the market, you need to be in the mid caps and the small caps. If you want to trade or invest in large caps, it is much better if you take the ETF route. The next section that we'll move on to is using market breadth as a guide to position sizing. Now, this was a chart I had shared in my previous update. In this particular chart, the number of stocks above 50 DMA were about 41%, within which 50% were well extended above 50 DMA, which told you that there were fewer opportunities in the market to trade. Similarly, 44% stocks were above 200 DMA, but out of these 44%, 40% were way too extended. Again, you could not buy extended stocks as the market breadth was really poor. Now, I'll just give you the current update. Number of stocks above 50 DMA are roughly about 48%. I've taken only liquid stocks here. Now, out of which 21% stocks are only extended, which means the quantum of opportunity has increased in the market. That is number of opportunity, not quantum, mainly because we've seen some time correction also, plus some price correction also. Similarly, 44% stocks are above 200 DMA, out of which now 17% are only extended. Again, the number of opportunities whenever the setup happens, I'll speak some bit about the setup also, is relatively much better as you had in the previous update. And finally, when it comes to 200 DMA, that is Nifty 500 stocks only, the 500 index, within which 43% are above 200 DMA and 14% only remain extended, which means in the last bit of correction that happened in the last 15 odd days, even the extended names pulled back a lot. The next market breadth chart is from the mid to large cap space, that is the 250 large to mid cap index. Now this chart is very interesting. It's interesting because the number of stocks above 50 DMA are about 79%, above 200 DMA is about 72%, above 100 DMA is about 74%. This tells you again that the concentration of the market today with respect to all the pockets in the market, sectors in the market, is actually in this space. Yes, the market is narrow in terms of breadth. A narrow market is obviously not that strong, but it is strong within a very narrow pocket, and that pocket is the mid to large cap 250 index. The next section that we'll visit is using sectors to pick stocks in the market. See, if you look at certain sectors in the market, and these sectors I have repeated in my last video also, prior to that, and over the last 3-4 months, it was very clear which sectors were actually leading the market. Auto index, again, it is at an all-time high. Look at the relative strength. This is something I've repeated so many times that I don't want to repeat again and again. Look at the metal index again, at all-time high. Look at the relative strength. Look at the kind of volumes that have come in. Look at the kind of stock performance that has played out in metal index. Again, the metal index sign has not come here. The metal index sign started coming in August, September. You can just go back and check my updates back then. The PSU banking space, again, is set up right at 50 DMA. This is what you have to look for stocks also. Which stocks with strong relative strength are at 50 DMA, forming a beautiful pattern and heading higher. This is the exact replica you have to follow. Again, is PSU bank a new theme? No, it is not. It has been there for the past 3-4 months. It is just that the news flow turns so bearish that it is very easy to forget what is leading the market. Overall, Bank Nifty also is doing very well. Finance sector is also doing very well. I think private sector banks is also setting up. Rare Earth Index, this is a custom index I had spoken about, I think 3-4 updates earlier, because government was focusing so much on this. Look at what has happened to this index. I had just taken 5 main stocks that are into this particular space. Look at the relative strength. Just this amazing kind of movement has happened in this particular index. What is the template that I follow? Again, this is a chart I've shared so many times with you. While the stock is contracting, not falling much, Nifty keeps making lower high, lower low. Such structures you have to go behind. This is not my concept. This is a concept of William O'Neill. This is a timeless concept that has worked again and again, and it is going to work for the next many decades. Whenever broader markets are not doing well, look at which stocks are not falling much. Those are the stocks you have to pay attention to. So banks were doing this, finance was doing this, metal was doing this, auto was doing this. There were plenty other pockets that were doing this. So it is not that the market overall was heading lower. It was the section of market, which is the SMID space, which is certain sectors, were just not in the right kind of structures. And see, whenever the market breadth, the overall market breadth is very weak, it becomes very difficult to take large bets in the market. That is why you have to keep position sizing a little bit smaller. So first, the sector. This is the exact replica of a chart that I had put out a few weeks back. That is why the strikeout that you see here, this is actually those sectors that when I gave out the previous strong sector list, they actually did not materialize. So banks were there, finance were there, hospitals, chemicals, agrochemicals, capital market, auto, insurance, broking, they still continue to lead the market. What did not work out? Back then, defense was in a very good structure. That structure has somewhat neutralized. I think defense needs some more weeks to set up. I'm super bullish on defense space. And hotels. Yes, hotels was a bit surprising because it was one of the strongest pockets in the market, but then you started seeing this particular space going below the 50 DMA and started sustaining below the 50 DMA pivot. And since then, it has not done well. Capital market is still setting up. I think within capital market, pay attention to companies that have been newly listed. Yes, they are coming in at exorbitant valuations. These companies cannot be a blind buy and hold play, but can they offer sometime a fantastic trading opportunity for 6 odd months, 8 months? Yes. That's why you need to keep those stocks on your radar. Just track it. If it forms a beautiful base at 50 DMA or gets into a beautiful relative strength breakout against broader market Nifty 500 or Nifty 50, try and take some exposure. There's nothing wrong with it. You have your stop loss rules to help you out in case trades were to go wrong. So irrespective of sector strength, the large to mid-cap stocks continue to attract more money. This is a trend that will again continue for some more time. Position sizing and pullback. Now, this is something you have to understand. Position sizing can be increased, especially in pockets where sector strength exists. But you have to understand that the broader market breadth is still poor. Less than 50% stocks are above 200 DMA in the entire market. This means that when the breadth of the market is so narrow, the VIX is so low, VIX is currently at 9.3, 9.4, there can be instances where random pullback or sell-offs begin in the market. So you have to be mindful of that. It is how it is. You cannot wish for something that is not being shown on the screen by the market. Currently, the breath is poor. You have to be nimble-footed. You only have to be in strong pockets, strong sectors in the market. This I will repeat again, and please listen to this. That is the speculator versus long term. You need to have a long term approach. Being a speculator will only make the system rich. A lot of people despise the system. I can completely understand, but if you are a speculator or a short term participant, actually you are the one who's making the system more rich. So short selling, FNO, BTST, it damages your account, it damages your psychological health. You just don't even know it. So this is one of the reasons why I don't even spend 10 minutes on social media in a week. This is the reason, because you get to see so many stupid things and stupid logic with respect to markets. It is not that only I know about stock market. There are millions and millions of people who know about stock market, but what you know about stock market is what helps you decide what you need to do. If you start listening to or reading thousands of opinions about markets, about XYZ sectors, XYZ stocks, then that will obviously lead to a lot of over analysis. I firmly believe that India is in a very strong footing. I think we are one of the strongest economies currently in the world, irrespective of what you hear on the media. I don't believe anything that they say. The data is visible. Yes, there is a spending problem that is developing in the country. By spending problem, I mean, if you talk to a common person, he'll tell you price of things have gone up a lot and they're not able to save money. But if you analyze their spending pattern, you will, and this data is available with RBI, you will come to know how much of mindless expenditure is going on in our country, especially age group of 25 to 40, things that people don't even need. They're spending on those things, and then they are not able to manage their finances, and that leads to a lot of frustration and those kind of things. So this is a concept that I had read in Radhika Gupta's book recently. It's a beautiful book about good debt and bad debt. In India today, the younger generation is piling up a lot of bad debt. A good debt is when you invest in a house. A good debt is when you take a loan to get yourself really educated, so that essentially becomes an investment. Whereas a bad debt is buying phones on EMI, buying cars on EMI, buying depreciating assets on EMIs, and that is what is currently happening in our country. And majority of noise that you hear about economy, about lack of opportunities, about lack of savings, it is actually by people who have not sorted out their personal finances. It's a bitter pill to swallow, but it is what it is. RBI data does not lie. You can just go to RBI website, and these data about spending patterns, etc., is clearly visible. So our market will be slow. By slow, I mean you cannot expect a 2021, 2022 kind of phase in the market. A market will be slow because the ratio charts are also suggesting that the broad-based rally in the market does not exist still. You also have to be mindful of what the global markets will do. Currently, the global markets are okay, just about okay, I'll tell you. There's no major movement happening in global market. I can see S&P 500, Nasdaq is also slowing down. So, and this first quarter, I think January, February, March, April, I don't expect a lot of good things in the US in terms of price movement. So if the US can just stay in a range, I think our large to mid cap segment will head higher. Sectors like banks, finance, autos, metals, some bit of oil and energy is also moving. It is just that I don't track that space that closely. Rare earth, new age economy stocks, these will do well. US just has to remain in a range. One obviously data point that I'm tracking is the Indian VIX index, because Indian VIX is at 9.2, 9.3, which is fine. Again, a lot of fear mongering about this index. See, VIX has to be in a range of 9 to something like 13, 14. We are going to be okay. Once it starts going above this 16, 17, 18 band, that is when you have to get a bit worried. Don't worry about INR. That is our currency. A little bit of depreciation here and there, does not matter. It is following the historical trend of depreciating every 2, 3, 4 years. So there's nothing wrong there. It is just that when it touches 90, 91, 92, you start hearing a lot of opinions. I think that is completely fine. It is in sync with what is going on with respect to global markets, global economy. A lot of things are reshaping, a lot of things are changing, and that is where I feel we are in an excellent position, because macros don't lie. That is how it is. All right. So I'll see you next week again. Have a great weekend ahead. Take care and be safe.